course, welcome everybody to Economica, all about economics and finance. Very happy to be with you all today. And yes, we have very special content today. We are going to see the ins and outs of the copper market, the gold market, what has been happening in gold prices in the stock market, and I'm going to explain to you all something you have all been missing, so that basically within the next 5 to 10 years, within the next decade, the whole global economy is going to run into a shortage, a supply shortage of copper. This is something that actually is not known, is not talked about, and many parts of the global economy, institutions, financial institutions, governments, the broader society, they are not aware of the fact that we are already running a very stretched supply and demand curve for what concerns copper as an industrial metal, same as for gold, and that we don't have enough resources, geological resources, to match the demand and to accommodate, to supply the growing demand, especially for copper. That basically concerns the expansion of the AI data centers, the electric vehicles, the expansion of the grid, the expansion in demand for energy. So all these facets, all these aspects of the global economy, whether it's production of EVs, smartphones, the building of massive AI data centers, all this stuff requires copper, and we do not have enough of the material. This is going to be a very crucial point going forward, also in the near term, with all the global energy shock and the supply chain constraints. We are losing sight of the fact that in the long term, not really in the long term, within the next decade, as you can see, the demand and supply of copper will face a 7.4 million tons shortage. So what that means is that demand will outstrip supply availability of industrial metals such as copper, which is it cannot be replaced by any other metal. In some instances there can be aluminum that can be used, but copper is an industrial metal which cannot be replaced. There is no substitute metal that can replace copper in any of the devices, that is smartphones, wires, as I said, electric cars, data centers. So the demand for copper is completely inelastic, and we do not have a material that can substitute copper for us to be able to continue expanding our global economy, whether it's, as I said, AI, so forth and so on, data centers. So it has been estimated that by 2035 there is going to be a mismatch between supply and demand of approximately 7.4 million tons of copper. What that means is that basically there will not be enough supply of the industrial metal. And the most interesting stuff is that even if we start to build, we start to build copper mines today, it will take at least a decade, maybe longer, 15 years. On average, it's 19 years for a copper mine to be in operation and to generate grade or copper, the mineral. But this is not the only thing. The other issue that we have is that the purity of grade or copper that we are extracting today, it's of a lower quality than what we used to have a few decades ago. So what that means is that for any certain amount of rocks that are mined into copper mines, also in gold mines, Today we are able to extract 0.7, 0.8% of copper, of grade ore copper, which means that it's less than 1% what we actually are able to extract as a mineral, that as rock that we can then transform in industrial metal, right? So instead, few decades ago, the percentage of grade ore copper was between 1 to even 4%. So now, today, we have highly intensive mining operations across the globe, which are very expensive to run, and they have to mine more and more tons of rocks, of surface earth crust, to extract less and less grade ore copper. So not only we are going to see a shortage into the market of more than 7 million tons of industrial metal for copper, but even if also the mines that are operating today, some of the mines, the quality of grade ore copper is less than 1%. So even if we have projects starting today, it can be Freeport McMorans, it can be BHP Billitons, Glencore, and all the other mining multinationals, it will take for them a decade or more to be operational. So the critical thing is that the supply of gold, of copper, and any other material that involves mining operation, the supply is not fast. It takes many years to be available, to be operational, to actually generate goods, commodities. And while instead the demand is very, very fast, it rises exponentially. So the demand for building AI data centers, it's actually needed now. So there are industries or manufacturers from Asia, semiconductors, to the United States, which every day they are eating the COMEX or the London Metal Exchange with rising and rising demand for industrial metals, and in that respect, rising demand for copper, and they cannot find it. I mean, the suppliers, they find very difficult to supply copper industrial material for the so great demand that we have. And for what we know is that the average price for example, for turning to gold for JP Morgan, for 2026, it was $5,000 an ounce. But instead, if you go and see Goldman or Wells Fargo, they have a price target of 6,000. Gold, for sure, gold prices are going to double, if not treble. And probably they will be $8,000, $10,000 in a few years from now, because the supply of gold it's as constrained as the supply of copper. And as I said, it takes many decades for these commodities to be available. So there is inelasticity, and the supply does not come online immediately. Then we have the Bloomberg also, they made a study and they estimated that the price per ton of copper, it would be around 13,500. I bet it would be way more than that, around 15,000, probably more. And crucially, you can see that if we want to match supply and demand, we will need 100 new mines to be operational by 2035. But I do reckon that by 2030, within the next 5 years, we are going to see exactly what I'm saying now, the huge mismatch between the rising demand for copper as a metal and the actual supply. So that's the very interesting point we are going to see today. As I said, you can see that across decades, the purity, the ore grade copper that we are able to extract from mining operation has declined from 5% to less than 1%. The quality that we have today, it's between 0.7 0.8. These are all official sources. That would be S&P Global, Wood Mackenzie. So these are all studies that have been made well in advance, because we are going, for sure, the market is going to experience a crisis points for what is industrial metals. and also the semiconductor industry, they will not be able to find enough copper or gold for building semiconductors. This is going to be really a crucial, a focal point for the whole global economy. And so in 120 years, we have 85% of grade deterioration. And what that means is that mining requires 7 times more rocks, material per ton of copper than in the 1900s. And when we need to, when a mine needs to work 7 times more rocks to find copper or gold, the material that they need, it means that the operation is way more expensive. In fact, there are gold mines in South Africa which would become unprofitable whenever the price of gold would be below $4,500. If the price of gold goes below $4,500, those mines in South Africa, they will become unprofitable, because their mining operation, they are so expensive, because they have to dig 5 kilometers under the surface of Earth, and they have to excavate many tons of rock to get so little of gold, that the expenses are really growing way more than what they are able to generate as a profit, basically. So also we see that another issue could be the mine permitting. It can take up to 25 years. So also the planning operation of setting up building mines operation, it takes time. Then we start to get a few numbers which are interesting. So an electric vehicle requires 50 to 80 kilo of copper, compared to a standard petrol car, which would require something between, I don't know, 5 to 10 kilos, but way less. So the EV industry, it's heavy consuming of copper. Every and each vehicle requires between 50 and 80 kilos. We have another example that AI data centers, they are really something, there is a demand from the AI data centers industry in the tons of copper, and this demand, it's now. They need it now, while any mine, it would take 10 years to be operational, and then you will have to excavate so much material that will take probably 15-20 years to have 27 tons of copper. But AI data centers, they need tens of tons of industrial metals. They need it now. So you can see that the mismatch in demand and supply, it's actually real, and it's happening now. We are able to balance because we are more or less around the 20, 22, 24 million tons per year. So there is 24 million tons production per year. Demand, more or less, is at that level, 20, 22 million tons. But demand is going to grow exponentially. It's already growing exponentially, and there is no supply. Okay, there is no other way to put it. There is no supply, and you can see that EV charging point, they need 8 kilos of copper to have the fast charger. So if you want to charge your Tesla in 5 minutes, in less than 10 minutes, even a fast charger for a smartphone, so forth and so on, you need copper. Wind turbines, they need 4 to 5 tons of copper. And if we want, or we must upgrade the whole grid system for this whole load of energy that we're going to need to generate, to make it available on the grid, then that needs even more copper. And so that's why we get to the fact that by 2035, but I believe way earlier than that, there's going to be a 30% mismatch between supply, available supply, and demand. And it means that demand will grow eventually to 30 plus ton per year, while supply will struggle to stay around the 22, 24 million tons per year. And so projected estimated gap, that would be, as I said, from the IEA or the Benchmark on Mineral Intelligence, Bloomberg, Wood Mackenzie, who do these studies well in advance, because they see what is coming, what is rising to the horizon, on the horizon, what is rising up on the horizon. They have estimated that there's going to be around 7.4 million, or at least a 30% mismatch between the actual supply of copper and the growing and growing demand, exponentially growing demand, especially for EVs, AI data centers, wind turbines. Those are going to be really crucial points. So we can see that eventually, when there is a 30% mismatch between supply and demand, you can expect that the price is going to increase at least by 30%, if not even more. So today we have the price of copper, which is around $10,000, perhaps more. If you give me a second, I'll pull up the chart from the other website. Like if we take the LME website, the London Metal Exchange, you can see that the price of copper past Friday was 11,929.50. And it closed down minus 1.8%. It was triple witch Friday, so it was a very heavy selling off day. But according to other estimates, we can see here we are in the orange line, which is the base case scenario. We are already at 12,000, 11,900, 12,000 per metric ton. And you can see that in the next 5 to 10 years, it's projected to grow to 16,000. And if the acute shortage scenario would materialize, deficit scenario, we all could be looking at 20,000 plus per metric ton of LME copper price. So you can see today it's almost 12,000, which is right in line with what was JP Morgan estimate of 12,500. Not so far from UBS. The average value of Bloomberg was 13,500, but copper prices, they have been reaching all-time high, historical all-time high, without ordinary people noticing it, because there is this underlying feature, there is this structural mismatch in supply and demand. And within the next 5 to 10 years, as I showed you, not on my own thinking, but according to sources, which is S&P sources in the IEA or Bloomberg, they are forecasting of a 30% mismatch between demand and supply. And so that means that with the deficit scenario, price of copper could be 20,000 in 5-10 years from now. And so that will be really interesting, because not only there will be a shortage of supply of industrial metal, but eventually this will become way more expensive. And that will pose all sorts of interesting dynamics and questions in the balances of the global economy. Who will be able to get hold of industrial copper and build cars, wind turbines, and AI data centers, so forth and so on. And which countries will struggle to get hold of this material. This is actually a very concrete problem that many countries across the world, they are going to face a sort of I don't want to say the big word, but it's a strategical problem. It's a strategical issue, because we don't have enough resources, and it will take 10. We need at least 100 new mines to start to be operational, and it takes more than a decade. We don't have these numbers now. We don't have the capability of generating those millions of tons that are already in demand, and they are going to be in demand. And it takes more than a decade to eventually level demand and supply, and unless there's going to be some demand destruction in future, what that means is that some economies, they will be left behind. So that's why this precious, not industrial metals, what trades in the London Metal Exchange and the COMEX, they are overlooked. Nobody cares about commodities. Nobody cares about grain, milk, wheat, copper, aluminum, gold, silver, palladium, platinum, cobalt. Nobody cares about this stuff. But this stuff, the heavy material stuff, the old stuff, it's what matters, because these are the things that we need to build smartphones, cars, so forth. What we have today, it's a lot of attention for the oil market, the global oil market. okay, which is reasonable because we are all concerned about eating oil, so forth and so on. And with that, I can tell you that that is not only that problem, energy, it's the infrastructure and the basic, the structure or the basic metals, industrial metals that we are going to need. We do not have enough, and we do not have enough capacity, mining capacity and industrial capacity to supply for all the demand that we have, the build-up of demand that we have already, okay? Because the only Microsoft data centers requires hundreds of kilos of copper just for one data center, okay? And I showed you that you can find your sources as well. I shared with you that one EV car, an electric vehicle, requires between 50 to 80 kilos of copper to be manufactured, on top of lithium, cobalt, so forth and so on. And we don't have supply on any of that. So that's a no-brainer that if the price of copper is now 11, 12,000, for sure it's going to be 30% higher, 50% higher. And there are already estimates from the big banks in Bloomberg which are trying to figure out where this is going to go, because this is going to be a sort of another crisis that we will be approaching. And so for sure it's going to be more than 12,000, or it can by 27, 28, 2030 it will be between 14 to $16,000 minimum for metric tons. And so that makes also the case for investing in copper, because what most people do not know is that institutional investors, they do invest in physical copper as if it were physical gold, and they keep it stored in London Metal Exchange or the COMEX, and they will keep it there as a safety, also as a sort of resource that it's needed. Okay, so copper is also an investment from a metal point of view, but we will see that later. So those are the projections depending of which disruption scenario we are going to see. If we are going for the 7+ million tons of demand and supply mismatch, well, the price of copper will likely be more than $20,000 per metric ton. And so here you can see the actual material mismatch in supply and demand. As I said, we are around 22, 23 million tons, 24 million tons between demand and supply. Already now, you can see that the light orange bar is the supply metric tons, and it falls a little bit shorter than demand. These are all official sources, as I say, Benchmark on Mineral Intelligence, Red Cloud Securities, UBS, ICSG. So these are all institutions, financial institutions or research centers that they are already concerned. They are already mapping out where the structural mismatch of this level between the growing demand and the steady supply, which is inelastic, and it takes, the demand is inelastic, but the supply is very slow. It takes decades to build up. Mining operation, they don't just produce anything in one day. It takes decades to be operational. And so by 2030, 2035, there is this scenario of north of 32, 34 million tons of copper that we will need as a mineral, and we will not have enough supply. So we are already, there is, in 2025, the deficit has been estimated at 150,000 tons. So that's why the price of copper has been reaching all-time highs already, but nobody cares, because they are all probably concerned about the stock market and I don't know, AI, AMD, all this kind of stuff. Okay, but here you can see the chart here. Okay, go and pull up the chart on TradingView. The price of copper here, that's an historical all-time high, $6.58. Okay, for high-grade copper, and that was in January 2026. Now it's retracing a little bit, but this is going to, I don't know how high this will go. Okay, you can see it's clear from the chart that it has been rising exponentially already from 2023, but the big acceleration with AI and the whole data center demand, it has pushed already to an all-time high of $6.58 58 cents of high grade copper, and this is projected to increase. I don't know where. I cannot just pluck a number on a chart, but matter of fact, copper already has priced an historical all-time high, and for sure this will go up again to 7, 8, 10. I don't know where, but the price is going to grow only. There is no other way, because there is already in 2025 there was already a deficit. In 2026, because we are in 2026, it's estimated a deficit of 330,000 tons. By 2029, we are talking about 500 plus thousand tons of deficits. By 2035, the gap can totally diverge completely in the millions of tons of mismatch between supply and demand. So that means that the price of copper will continue to go higher, become more expensive to mine and to get hold of. So on the other side, we have also we have seen also all the dynamic of gold, and the dynamic of gold also are very interesting, and in this respect they are very similar to the material mining copper shortages that we are facing already. For what do we know is that the S&P Global has forecast a peak of 110 million of ounces in 2026, and from 2026 gold production will be declining, even though, and even for this reason, price is north of $5,000. The all-time high was $5,500, but it's estimated to reach at least $6,000 per ounce. And you can see that even though prices are at sort of all-time high, the mining production grew by 1%. So what that means is that there is total inelasticity in the gold market. And with all the ongoing issues with energy global shock, geopolitical uncertainty, central banks, they did start well in advance to pile up on gold. It's a well-known fact that the Indian central bank of China, other central banks, they decided in 2023, 2024, 2025, since after the ongoing issue on the border between Ukraine and Russia, central banks, they shifted and they started to pile up in gold. And you can see that the mining supply, it's only expanded by 1%, vis-a-vis the humongous demand that it's already it's shown up in the price of gold, which are going also. There is no other scenario for the price of gold to even grow even more. 6,000, 8,000. I will not be surprised to see gold at $10,000, because there is no material in the surface of planet Earth. We will not have a viable economic mining operations that would be able to extract gold at a profit, unless the price will grow even more than where it is now. Because the floor price now is 4,500, 4,500 for some mines in South Africa, but if it becomes more and more difficult, then prices will have to grow. Estimated proven reserves 54,770 tons, and we have a short lifespan of 15 years. So within the next 15 years of known reserves, then we don't know we will not know and where to find gold. These things, they are not explained anywhere in ordinary mass media, even in investment banks or some investment advice. But again, we are going to see, we already have a structural supply deficit, whether it's gold, mining stuff, whether it's copper, and we do not have the capacity, the mining capacity. It's not in place to match the growing demand that we have. So this is going to be really, really interesting. And okay, The price was 5,590, short of 5,600, the all-time high for geopolitical risk. Now we have even more geopolitical risk and a lot of uncertainty, so I bet that the price will go higher for sure. Central banks have bought 800 tons, and 95% of central banks, they of course are planning to increase gold reserves. I would place at the top of the list the Central Bank of China or the Central Bank of India. I'm quite sure that they are going to, or they already planned to steadily increase their gold reserves. And also, what is not known widely, but it's observable in some components of computers and semiconductors, there is an industrial use for gold. So there will be growing demand for gold also for industrial production. That will be, of course, driven or pushed by the AI data center expansion. And what is really interesting that for some technology, this is more technical, so the bonding wires, the chip production, and the very high quality fast connectors, they need gold, and it's a material which has no substitute. The same is for copper. We don't have a material, an industrial metal, which can replace whether it's copper for wires and everything, and even gold for some certain microchip connectors or semiconductor connectors. And then there is also the growing demand from the financial markets, where it's ETFs, which they are looking in the medium to long term for preserving capital, and so they park money into gold, or perhaps they can park money into physical gold or physical copper. And so those are all the features that create a huge demand for gold. And you can see what are the estimates from the big houses in Wall Street. Goldman Sachs was really the most conservative, the most really out of skew. JP Morgan, it's looking at a round number of 5,000. UBS, Wells Fargo, UBS, it's actually on target. It's because prices in 2026, they've been between 5,000 and 5,500. So we are there. Wells Fargo is already seeing a price going to 6,000, north of 6,000. And of course, JP Morgan also, they put out their upside estimate target price of 6,300. So investment banks, they are already, they won't say positioning, but they expect, according to their models, which must be reliable in a certain way, that the price of gold, it's bound to grow inevitably because of demand, because of the structural scarcity of the material. Mining operations are not coming up. It takes decades for a mine to be operational, and still we have a huge demand of gold. Bank of America, 8,000 by 2027. These are very interesting data, because you can see that the consensus range from the big houses on Wall Street, the big investment houses on Wall Street, by 2030, which is 4 years down the line, it's between 7,000, 750, and almost 14,000. So price of gold is going almost to double or treble within a few years, which makes the case for investing into physical gold in any kind of way, whether it's coins, bars, anything that you can find, if you can find it. Because the price eventually is going to increase, and having your wedding ring or your official engagement ring eventually will become very expensive indeed. So there are, here we have a technical table which explains us the unique features of copper and why technically we do not have a metal since the Stone Age or the Metal Age. So since some 3,000 to 4,000 years ago, we do not have a material which can replace copper in anything that we want to produce. Our smartphones, nowadays, on average, the global citizen, it has at least 1.5, 2 smartphones per person. Like if you go in the United States, any citizen probably they will have on average two smartphones, like an Apple phone and Android. If you go in Europe, there is on average per person 1.5, two smartphones. Okay, so we will not be able to produce enough stuff for the demand that we have. Same is in China, and so forth and so on. So copper is the best and only unique industrial metal that has perfect electrical conductivity. So whether it's quantum computing, AI, Tesla motor, magnet rotors, smartphones, you name it, batteries, you need copper. And it's the best material for thermal conductivity, and it's the flexibility of the ductility of bending copper, working it and make it like round shapes and add those rotors or magnet. It's the best material, and by the way, it's somewhat cheap. It's affordable for manufacturing of industrial production of large scale, and it's an essential item for whether it's normal cars, EVs. Uh, but the only thing that would save us a little bit is that recyclable. So we can have discard copper and we can recycle it. That's why from time to time you will see on newspapers that there are people who go and steal copper wires from train stations or old buildings. You may ask yourself what they have to do with copper. Yeah, actually it's very, very valuable. And if we compare the physical qualities, features, characteristics of copper with aluminum or silver, you see that already aluminum, it does not have the same quality of electrical conductivity. I don't think you have aluminum wires for any electrical circuit. The thermal conductivity is good, but aluminum critically it cracks. So it's not very flexible, and that's why under stress or pressure or long periods of high temperature, it can crack. It breaks apart basically. Then you can see that aluminum oxidizer connections, it's cheaper than copper, but we cannot use it for the large scale production that we need today. It's heavier than copper. You will not have like aluminum in your car because it becomes way heavier. And it's recyclable, but the quality is not great. Otherwise, if any smartphone producer, they will need to use silver, which already is way expensive. It's 180 times more expensive for electrical. I don't think you have wires in silver, so forth and so on. So we cannot use silver for manufacturing cars, etc. So there are also, for those who are for physics, they understand very well why copper is irreplaceable. We don't have a substitute. This is critical for civilization. Since we start to use copper, to discover copper like 2,000-3,000 years ago, now we are running out of it, and we don't have a substitute material. And I don't know how we are going to sort it out. So the price scenario that we could have, it's north of $20,000 per ton, whether it's copper or it's gold. Gold, it's bound to rise way faster because prices still are lower, and also because the measure is different, because copper is sold, being an industrial metal, is priced by metric tons. Gold is priced by ounces, so you can see that the weight, the quantity is different. But inevitably, prices of gold, within next few years, they're probably going to double. Probably in 2026, we will see $6,000 gold, and we are going to have a lot of volatility in the copper market, which it's going to be very, very interesting indeed. So what we have basically is that supply gap of copper, it's already happening. We have in 2025, production was short of 150,000 tons. We are this year around 300,000 tons short of copper. By 2030, 2035, we are looking at millions of tons, like a 30% mismatch between the supply and demand. We will need roughly 100 new mining operations globally if we find the rocks that contain grade or copper, and it takes more than a decade for a mine to be operational. And here, my decade, here we have 25 years for mining operation. So while instead you can see that whether we need to build EVs or AI data centers, there is inelasticity. They will have to produce and price, and whether it's I don't know, Nvidia or Microsoft or Taiwan Semiconductors, they will pay any price to get hold of copper as industrial metal. Those long, big metal sheets, industrial metal sheets of copper, already big producers, industries, they are paying over the odds because they cannot hold of the material enough. And so price range 2026, 12,000, 12,500, probably more. We'll have to see in the back half of the year, with all this supply disruption for Strait of Hormuz and so on, what is going to mean for all the commodities, whether it's grain, food, agriculture, mining and metals, and so gold, copper, so forth and so on, and oil, eating oil. What is going to mean? We are going to see a huge bull market in commodities. And same is for copper, for gold. Whether we have some hopes that we would see mining production in copper, gold production as a mining production is going to peak in 2026, and there are no mines. There is no way. There is nothing on the horizon of the big mining multinationals which have in project gold mines, because it's becoming way more difficult to mine gold because it needs to go further and further, deeper and deeper. When you need to mine deeper than 1, 2, 3 kilometers down the surface, it becomes more expensive because you have to extract more rock that you don't need, and that is the mining operation becomes more expensive, and so you need a higher price of gold mineral for your mining business to be profitable, to make sense, basically. And so there will be the three main factors: scarcity of the material, there is no supply, there are no mines coming up, there is going to be continuous demand from central bank of physical gold, technology needs gold, and price range it's way above the $5,000. So what we saw in the market in the past week was probably a volatility event driven by option expiry and the search for liquidity from hedge funds, speculators, because also we saw that bond market, they were heavily sold off. So the past week, past Friday, where there was a triple witch expiry, and the whole week was a liquidity seeking stock market environment. So hedge funds, those big investment funds which are leveraged, they probably sold a lot of stuff because they are going to cash. They need liquidity for some other reasons. And if we take the chart of gold here, you can see how the past week was very volatile, and we have approached like a Fibonacci level at around 4,500. Friday was 4,490, which is 4,500, and we are oversold. And if we go on the 4-hour chart, it was oversold for basically many hours. The RSI at some point, the minimum was 18. It was a really oversold RSI, and I would expect basically the price to go to bounce up from here, because we are on Fibonacci retracement levels here, and eventually, almost for sure, the price will there will be upside from here. I mean, setting aside the short-term stock market speculation, there are structural features which make the availability of physical gold a huge problem in 2026 and also for many years to come. And so I don't know if we take the longer perspective, longer horizon, this weekly chart, this is my draw, but probably we will have a... So we see how there was a huge sell-off from the all-time high, which basically it's a liquidity event. It's a option pricing, positioning in market, funds that needed liquidity. So you are basically selling at an historical all-time high. You go for liquidity, but then the trajectory it's eventually to go higher from here, and the target it's 6,000 in 2026, I believe, for UBS or Wells Fargo. Not this one. 6,000 will be around here. Yeah, 6,000 is here. Okay, so if it rallies to 6,000 from here, more or less, we are going up here. Okay, it's like a 32% rally that is expecting gold, probably more than. So we have 6,000 as a target. Okay, we have a base price 4,500. Yes, 33%, more than 30% going up. Which is difficult to realize now because you see a huge sell-off, but eventually there is structural mismatch between supply and demand. There is shortage of supply of gold, and there is a very high structural demand. So eventually the price will start to go up again. It will be, I believe, very surprising for how far expensive gold will be, because there are scenarios pricing 10,000. Yeah. 10,000, it's way higher than here. 10,000 it's here. So probably if you tell me, okay, buy gold now and hold it by 10,000, it's sure. I don't know, but that would be a massive upside eventually here. In percentages, there will be probably an astronomical percentage of upside to 10,000, more than 100%, I don't know, which is not unreasonable. Okay, yeah, it's 120% or something like that. Anyway, and you can see by the by, this huge volatility move in the market, it's like was a lot overbought here, was 95 on a monthly print. But eventually the relative strength should continue being as a sort of strong upside. That's what it will continue to be, on a strong upside, and eventually prices of gold will continue to go higher. And so if you are interested in investing in physical copper or physical gold, you can access the holding of physical copper at C4CU, which is Copper for You. This is a company that works with the London Metal Exchange, and they will allow you to buy, instead of metric tons, they make possible for retail investors to access the physical copper market with the London Metal Exchange, and to buy small quantities, which is 10 kilos, for the price of $120. And they will store it for you. There is no cost. If the website is c4cu.com, and it's very easy. It's real investment grade copper, LME grade A, and basically you can, minimum purchase is for 1 kilo, which is $13. Okay, there is really nothing. You're not buying metric tons. You're not required to be some huge industry, Apple or Samsung. You're small retail investors. You can spend $150, and you are saving those money into physical copper at the London Metal Exchange, which is highly liquid. They do not charge any fees for storing your metal, etc. And you can sell at any time when you realize the profit, basically. They have also, you see, copper is stored and secured, it's insured, which is very important. On an app, you can track the price all the time, and you can basically exchange it at the London Metal Exchange, and you can gather liquidity. So the most beautiful thing is that these are not ETFs or CFDs. This is actually the physical metal. So this company is very, very clever, very interesting, because they are making available to small retail investors a material which is high in demand, and price will go higher, as I showed you, of this big conundrum of copper supply that will not be enough, basically. And so C4CU gives you the opportunity to own physical copper with the London Metal Exchange. Okay, just you can register yourself just with the Google email, and you can purchase the amount of copper that you want, starting from 1 kilo. There is only one time 5% service fee charge, which covers the cost of card or digital transactions, but then there is no storage cost, nothing. No monthly storage fees, no insurance premium, there are no additional costs, basically. And that's it. So it's very, very interesting if from an investing saving perspective, because you are saving in a material which is real metal, real ownership, and it's stored with the London Metal Exchange. It's stored here. So if when tomorrow, which is next working Monday, stock market opens, the London Metal Exchange opens, you can register with c4cu.com. You can also take advantage of the link that I will put into the description of the video. You can register for only $20 or $150. You can own between a kilo or 10 kilo of physical copper. Okay, you will pay $120 for 10 kilo and a 5% transaction cost, basically. And then when the price of copper from 12,000 will be 13, 14,000, 15,000, and so forth and so on, you will see your money growing, and you can exchange and have immediate liquidity without any problem. So I suggest you all see and register an account with the C4CU, and be the smartest person within the global investment financial industry in preserving your money with real metals, which are in high demand and there is not enough supply. So the price of copper, as the price of gold, they are bound to increase, they are bound to grow inevitably. And so this C4CU website, this company, it gives the opportunity to small retail investors to access London Metal Exchange liquidity and the owning of real metals. Okay, so that's all for me, and just make sure to check out this website, C4CU, Copper for You, which works with the London Metal Exchange. And be clever, invest in physical metals if you want to have a solid investment which is not volatile and can grow steadily across time.